Good morning and welcome to our annual press conference on the outcome of the 2025 Supervisory Review and Evaluation process. I'm Conny Lotze from ECB Communications. And here with me are Claudia Buch, the Chair of the Supervisory Board, and Frank Elderson, the Vice Chair of the Supervisory Board. You will have seen the publication of the press release, the SREP report, the supervisory priorities, and other accompanying documents on our website. We will start with introductory remarks by the Chair before taking your questions. Claudia, please.
Thank you very much and welcome. Good morning also from my side for the press conference on the Supervisory Review and Evaluation process, or SREP. Let me summarize our main messages. The first is that the euro area banking sector is well capitalized and liquid, but it continues to operate in a challenging geopolitical environment. And geopolitical tensions can quickly lead to concrete financial risks. We've seen this in the market reactions to the announcement of new tariffs earlier this year. So far, the banking sector has remained resilient, but it will take time until higher tariffs show their full effect on the corporate sector and banks' balance sheets. Second, digitalization offers opportunities and improves the provision of financial services, but it also increases competitive pressure and exposes banks to risks such as cyber attacks. Banks thus need sound governance to contain risk, and many banks need to invest into their IT infrastructures to remain competitive and resilient. Third, discussions on how to simplify regulation and supervision without weakening resilience have gained traction. We are reforming European supervision to become more effective and efficient while remaining clearly focused on risks. This creates space for banks and for us to adequately respond to evolving risks. Weakening standards would instead have negative implications for resilience and for the competitiveness of banks. It would also weaken their ability to service the economy well. Over the coming years, our supervisory priorities will focus on, first, strengthening banks' resilience to geopolitical and macro-financial risks and uncertainties, and ensuring robust operational resilience. Against these backgrounds, this year's SREP provides a comprehensive assessment of banks supervised by the ECB. Let me start with capital. The euro area banking sector remains well capitalized. The average common equity tier 1 capital ratio stands at 16.1%, higher than last year where it was 15.8%, and the leverage ratio remains just below 6%. Coming to liquidity, we see very stable liquidity ratios reflecting favorable overall liquidity conditions, with a liquidity coverage ratio around 160% and a net stable funding ratio around 130%. But reliance on market-based funding could pose risks in times of stress. Higher bank profitability, as you can see in this chart, has been supported by higher net interest margins. So on average, the return on equity for euro area banks is around 10% this year, which is 4.5 percentage points above the levels seen during the low interest rate period. But we're also seeing that the positive effects of higher interest rates start to level off. Higher interest rates are also a main driver behind improvements in banks' cost-to-income ratios, which declined from 66% in 2020 to 54% this year. Looking ahead, banks will have to balance the need to control costs while ensuring sufficient investment into IT and cyber resilience. Turning to asset quality, this on aggregate has remained sound. The average non-performing loans ratio stands at 1.9%, but we're also seeing, and this is the yellow line, that credit risks for performing loans has increased over the past years. But there are pockets of vulnerabilities. Non-performing loans are above average for commercial real estate loans with 4.6% and for loans to small and medium-sized enterprises with 4.9%. And we also see a somewhat heterogeneous picture across euro area countries with a tendency of non-performing loans to increase in countries which started from lower levels, and the other way around, non-performing loans fall in countries that started from higher levels. In the future, banks could face higher credit risks if higher tariffs or a weaker economy affect loan losses, which would also weaken the profitability of banks. Let me now turn to our assessment of the banks, which is reflected in the SREP scores. The average SREP score has slightly improved from 2.6 to 2.5 and gets closer to 2-. The scores tend to cluster more in the center. So scores of below average banks tended to improve. Scores of above average banks slightly deteriorated. Around a quarter of banks is in the weakest category, so these are the scores 3 and 4. The number of qualitative measures to address supervisory findings was reduced by 30% compared to last year. This reflects two things. One, our clearer focus on relevant risks, and also remediation that has happened on part of the banks. Credit risk remains the most important driver of banks' risk-weighted assets, and therefore also has the higher number of qualitative findings, so 40% of supervisory measures focus on this risk. This could be related to weaknesses in provisioning, and of course we also pay particular attention to areas where credit risk is heightened, commercial real estate and SME lending, as I've mentioned earlier. 17% of measures, qualitative measures, are related to weaknesses in banks' internal governance, another 10% related to operational risk, so this is cyber risk, weaknesses in risk management systems, and also weaknesses, deficiencies in internal information systems of banks, which could impair the taking of well-informed decisions by boards and management. With this, let me turn to capital. Capital requirements and guidance will remain broadly stable, around 11.2% in 2026 compared to 11.3% this year. Capital headroom across the system is quite stable, so we have no institution which is expected to fall below overall capital requirements, buffers, and guidance. Let me break these numbers down a little bit to show that Pillar 2 capital requirements remain broadly stable. 1.2% of CET1 will apply in next year compared to 1.1% this year. As you know, the ECB can apply add-ons to the P2R if risks are not sufficiently covered. In this year's SREP, the number of banks affected by these add-ons declined due to the remediation of findings. More specifically, P2R add-ons for insufficiently provisioned non-performing exposures were now applied on 10 banks compared to 18 last year. Add-ons for leveraged finance declined from 9 banks to 6 banks to which these apply. Coming to the Pillar 2 guidance for next year, this declines to 1.1%. In the past 2 years, it was 1.3%. As you know, the Pillar 2 guidance is not binding. It is informed by this year's stress test, which was motivated by an adverse scenario with geopolitical tensions common to all banks. So the small decline in the P2G reflects 2 factors. One, aggregate losses in the adverse scenario would increase by 14% compared to the stress test in 2023. Non-performing loans would also increase to 5.8%, so that's a level similar to what we've seen in 2014. So that's the first factor, higher losses, higher non-performing loans. The second factor are higher profits of banks, which would cover part of these losses. This is why the capital depletion would be 100 basis points lower than in the previous stress test. Let me also mention one aspect in terms of data collected from the stress test, which gives information on Basel III implementation in Europe, which you know is in effect since the beginning of this year. On aggregate, what we're seeing in the data is that banks' capital requirements did not change in 2025 due to the new CRR3. For some banks, capital requirements even declined. And of course, this is due to also the transitional arrangements which give banks time to adjust. So the euro area banking sector is resilient, and there are really three main factors behind this. The first is improved regulation, supervision, and also risk management of banks, which have made the banking system better capitalized and thus more resilient. The second factor is that firms and households have remained financially sound, even though severe shocks have hit the European economy over the past years. The third factor is that sizable fiscal support to households and firms stabilized the economy. During the pandemic, fiscal packages amounted to around 4% of euro area GDP, and fiscal support during the energy crisis was in a similar range. These measures also shielded the financial sector against higher credit losses. And of course, assessing banks' resilience to future shock needs to consider this. Fiscal policy is becoming more constrained, thus requiring strong buffers in the financial sector. Otherwise, in a stress scenario, banks would have to scale back their activities. This is also a reason why we need strong capital buffers in the system to preserve resilience. Since the pandemic, macroprudential buffers that can be released in times of stress have increased, and currently in the euro area, the CCYB stands at 0.8% of risk-weighted assets. There are no signs of widespread losses or credit supply constraints arising from capital requirements. We can also see this if we take a little bit of a longer picture over the past 25 years, where we see that banks have become better capitalized. The share of equity capital in banks' funding has increased. At the same time, the share of bank loans in financing the real economy is about as high today as it was 25 years ago. Recent analysis done at the ECB confirms that well-capitalized banks are also more efficient. Banks' profit efficiency increases until an estimated level of capital of around 18%, which is well above the current levels of capital and also the requirements that we see in the system. Let me now turn to our supervisory priorities for the next 3 years. The first is to strengthen banks' resilience to geopolitical risks and macro-financial uncertainties. We clearly see that economic policy uncertainty is heightened, but geopolitical risk, so the blue line is indicating economic policy uncertainty, but geopolitical risks are not reflected in financial market stress indicators. That's the yellow line in this chart. This creates the risk of abrupt reversals of market prices. So what do banks need? Adequate capitalization, sound credit underwriting standards, and also prudent management of climate and nature-related risks. This is our first priority. We will also conduct a reverse stress test in 2026 to identify which bank-specific geopolitical risk scenarios would impair the financial soundness of individual banks. Our second priority is related to banks' operational resilience and IT capabilities. Banks need operational risk management frameworks that are fit for purpose, and they also need to remediate deficiencies in internal risk data aggregation systems. In this context, we will also focus on banks' digitalization and AI-related strategies. The slides have already moved us a little bit further, namely to the question, so what can we do in order to make sure that we achieve these objectives, to deliver on these priorities? And we have a very encompassing reform program adapting European supervision to make it more efficient, more effective, more risk-based. Our reforms have 4 elements. The first is the reform of the SREP, which I described here already last year, which is well on track and which is already delivering in terms of faster and more targeted SREP decisions. The second is a project called Next Level Supervision, where we streamline all our supervisory activities, including on-site inspections, including stress tests, and as regards reporting, we remove overlaps and increase proportionality. We have a project on supervisory culture to implement these reforms in a consistent way across the banking union, and we measure the effectiveness of our supervision. All this is key to retain a strong and competitive banking sector in a challenging environment. As regards the banks, retaining financial and operational resilience is their best response to uncertainty and to digitalization. Resilience also strengthens their long-term business model and makes banks more competitive. Looking beyond supervision, Europe's policy response to global developments should prioritize maintaining resilience and promoting the single market. There's clearly room for more Europe. Many rules related to bank governance and solvency remain fragmented. Harmonization and simplification are actually 2 sides of the same coin. Harmonization also supports integration and thereby banks' efficiency. Finalizing the banking union, in particular European deposit insurance, remains essential. At the same time, Europe should remain committed to global standards, just as we remain committed to closely cooperating with our international partners. On our part, we will ensure efficient, effective, and risk-based supervision. This supports trust of investors and depositors in European banks. Weakening standards would instead weaken the competitiveness of banks. Thank you very much for your attention, and we now stand ready to answer your questions. Thank you.
Thank you very much, Chair. We have a lot of people online, so those who want to ask a question from online, please raise your hand in the chat and the colleagues will unmute you, and then we will go from there once I call on you. And there are a few people in the room, so maybe we'll start with a question in the room from Nick Comfort, Bloomberg. Wait for the microphone, please.
Thank you. I have 2 questions. The first will come under the next level supervision bucket. What specifically will you change in how you conduct on-site investigations? Will they be fewer in number? Will there be a greater role for the JSTs versus the horizontal teams? That'd be super to spell out. And then the second, I guess you could put under the close coordination with international authorities bucket. So there was a difference of opinion in the Basel Committee last month on whether the banking union is actually and should be treated as a single jurisdiction when looking at G-SIB buffers. What reassurance can you give big banks today with cross-border businesses that this will still be the case going forward, that they can plan accordingly and not see their G-SIB charges, surcharges rise as a result? Thank you.
Thank you very much for these questions. The first one is related to on-site inspections. So let me maybe explain what these on-site inspections are very briefly and how we currently organize them. So on-site inspections are a tool that we use if we really want to understand what's going on within the bank. So they're typically requested by the joint supervisory teams. So they, of course, do their off-site supervision. They see that there's a specific area where they would like to dig deeper, and then they request on-site inspection. So this is always coordinated with the joint supervisory teams. On-site inspections predominantly are staffed by colleagues from the national competent authorities. So around 85–90% of the colleagues come from there. So you can imagine that it's quite a planning process, which we actually do very diligently because it's very resource intensive. We can do better in terms of organizing this, in terms of having a consistent communication vis-à-vis the banks. This is something that we're doing already. We have an integrated planning process, so again, coordinating the off-site and the on-site work. But we also received feedback from the banks, and this is very well taken because we want to hear from them how they perceive our supervision. We also heard feedback that there's room for improvement. We can better coordinate this, we can better speak with one voice. And this is basically, in a nutshell, what we're doing. So improving upon the procedures that we have now, apply also the risk tolerance framework that we have for the other activities that you've seen it briefly in the slides for the SREP reform. We have a risk tolerance framework where we say we do not have to look at every risk for every bank with the same intensity every year. And the same, of course, also applies to on-site inspections. And we have now a lot of consensus, I would say, around the table to go into that direction, to be more targeted, because on-site inspections are also resource intensive for us, and we want to make it more integrated. One last word, we also use a lot our subtech tools to make that possible, because we often get a lot of information from the banks for the inspectors that they have to go through, and it makes it much easier for us to understand what is available in-house, what do we get from the banks, what do we need in addition. So these are basically the areas where we improve. Your second question was related to a discussion, and this was also partly covered in the media, about an agreement that was reached in the Basel Committee in 2022 of how progress that has been made in the banking union, how that is treated when it comes to the, not the designation of globally systemically important banks, but the calibration of the buffers, the additional capital buffers. And here the agreement was that cross-border activity within the banking union is acknowledged as 66% as domestic. And this is what we're currently applying, and I would say that we're also in a very good dialogue about this. I think it makes fully sense to acknowledge the progress that has been made in the banking union, and this is where we are. So it has all been also, with the EBA, it has also clarified how this is applied in Europe.
Thank you. I'm going to go to a question online and then come back to the room here. I'm calling on Francesco Ninfole. Yes, and he already put on his camera. Thank you very much, from Milano Finanza. Francesco, go ahead, please.
Thank you. Good morning. My first question is on government measures all around Europe that have slowed down the consolidation in the banking sector. What is your opinion on those, and do you think they could be an obstacle to the banking union? And secondly, I'd like to know your view about the simplification of rules in the banking sector, and especially on the simplification of capital requirements and the capital stack. What is your view on this topic? Thank you.
Thank you very much for these questions. As to the first one, I understood this as related to consolidation in the banking sector, cross-border mergers, and I think we've always made very clear what our role is in approving cross-border mergers, applications that come to us. So we have very clear criteria that are given to us in the legislation. We look at prudential ratios, governance, and so forth. And we certainly, and I've said this before, we don't stand in the way of cross-border merger activity. Of course, we need to acknowledge the risks, but we also know that there's many benefits coming from cross-border activity, a more integrated market, leveraging upon the single market. I would not want to comment on specific government measures. This is not in the prudential remit, but I think we are very clear on what our role is and how we are viewing this. As regards simplification and the capital stack, we've always said that we are very open to this. If there's ways to improve the capital framework, again, we would certainly not stand in the way. But of course, we need to make sure that resilience is maintained, that whatever is being decided is in line with the Basel framework. That's important for the European banks that are active globally. And it also needs to make sure that the division of labor between microprudential and macroprudential, that is being maintained.
Thank you very much. We go back to the room here. Balazs Kourani from Reuters.
Good morning. Thanks for taking my questions. After a couple of broad questions, I might be overly specific, but hope you can forgive me. First question is about the AI boom. Given an exceptional boom in the sector and investments, I'm curious if this is coming up on your radar. Are you looking at banks investing in data centers, AI? Is this just normal supervision, or are you looking at this sector more closely than previously? The second question is about stablecoins, given that plenty of members of the Governing Council have warned about the liquidity risk related to stablecoins, particularly in case of multi-issuance. What if there is a run? Could that create a liquidity challenge for a Eurozone bank? How do you see that risk? How acute is that risk? And what are you doing to mitigate that risk?
Thank you for those questions, which are both a little bit in the space of digitalization, which I said is really one of our clear priorities to look into what does it mean for banks and how prepared are they? There's business opportunities, but there's also risks. So maybe I was a bit short on our priorities. Actually, looking into AI strategies of banks is within our second priority. Operational resilience is one of the themes that's clearly high on our list and will also be a priority for the next 3 years. And this means, of course, many banks are experimenting with AI tools to become more efficient, to deliver better services, to do better credit risk assessment. But we all know that there can also be risk associated with it. There can be discriminatory lending practices that are promoted by AI. There can be also fragilities in the IT process and so forth. So, I mean, just this whole picture, we want to understand it better and also then work with the banks to make sure that the potential risks that are there, that they don't become prevalent. We're, by the way, also using, when I mentioned the sub-tech tools, we're also using tools like large language models in our own work, because we can't just, theoretically discuss these issues, but we also need to understand how these tools work in practice. When it comes to stablecoins, it's again, I would say, a digital innovation that is happening. It's, if you want, it's a combination between the money market funds and the payments mechanism. You may argue that since we have payment systems that function well in Europe, the business case is a bit weaker here than in other world regions. I don't want to speculate about this, but in any case, like any digital innovation, I think it needs to be well regulated because there can be, as you mentioned, volatility issues. There can be issues, in particular, in times of crisis. And this is why I think it's good that Europe has the MiCA regulation. It's also good that other jurisdictions are regulating stablecoins, but there can be cases where regulation elsewhere is weaker, different than in Europe, and this is where joint issuance and the full fungibility can create issues for also the euro area banks. So far, this is relatively small in terms of volume, but of course, regulation also needs to be preventive. And this is why I think what the ESRB recommendation said, I think it was issued in last month, that if there's differences in regulation across jurisdictions, then there should be equivalence arrangements, reciprocity arrangements. I think that's a good way forward to make sure that the benefits that are there can be reaped, so we certainly don't stand in the way of technological innovation, but also that the risks are being contained.
Thank you. I don't see any hands online, but I have one more in the room here. Carlo Boffa, Politico, please.
Hi, good morning. Thank you for taking my questions. I've got two. First one on the new methodology for the P2R. if you had to calculate this year's capital requirement, would there have with the new methodology, would there have been any differences? And the second one on Russia, if you can give us an update on the progress the banks are making, have been made in the last 12 months to exit Russia, and how happy you are with them. Thank you.
Thank you for the question on the new P2R. I think it was just the methodology was published this, today, and it's indeed important to understand what it is and what it is not. So what it is, it's in line with the SREP reform to become simpler, to be more targeted also vis-a-vis the banks. So this was our attempt, because the previous P2R methodology, I think, was technically very, very good, but it was also complex, and so we wanted to be simpler so that also the communication to the banks is more clear. So what remains is that the SREP scores will remain the main driver of the P2R. There will be a stronger link to the SREP scores, but this will be still kind of the main kind of philosophy behind the P2R. The reliance on the ICAP, the bank's internal capital allocation models, will be a little bit weaker. Of course, we will still look at it. And it will also be easier to integrate deficiencies, for example, in governance into the calculation of the P2R. There will be more room for constrained judgment, and that's also, I published a blog earlier, and this is also explained in the publication that we did today. And of course, we will evaluate very closely how this judgment is being used. No? So it's, of course, capital regulation, the P2R is not just mechanical, we need judgment, but we need to also assess how judgment is being used. So what we did in this year, we used basically the data that we have from the banks for this year. This year's SREP is still calculated with the old methodology, but we also used the new methodology, so to say, in a dry run to see what if we had used it, what would be the result. And we made sure that in this dry run, there wouldn't be any abrupt change in capital just because of the methodology. So this is what was done. And now we've done this, and we're checking all this very carefully, and then next year we will use the new methodology to calculate the P2R. And I think it should also be more transparent for the banks.
Thank you very much. Sorry? Oh, Russia.
Oh, there was another one, sorry. I was so engaged about the P2R. Well, yes, we monitor this very, very carefully. So now I think the latest number is that the exposures are down by 60 plus 61% or so, and I would not use the word happiness, because I mean it was a very difficult situation. We're working very closely with the banks, and I think also the banks have understood why the measures that we took were necessary. So this is on good track, but of course we monitor the situation very carefully.
Thank you. Again, I don't see any hands online. Do you want to, so we go back to Nick Comfort. He has another question, Bloomberg.
I could go on for hours, as people know in this room probably. I have a question on climate specifically. Well, a two-parter. First of all, how prepared are European banks for the requirement that they will start having their own transition plans for the transition to a low carbon economy or zero carbon economy maybe? And then secondly, how hard is it to keep them motivated and focus on this topic now that we have not just the US, but other jurisdictions as well, placing less of an emphasis on transition and at best, placing more of an emphasis on mitigation? Thanks.
I can take that question. So thanks a lot. Maybe I'll start with the second question. I think now, in comparison to, say, 5-6 years ago, where I remember in 2019, I think it was, less than 25% of the banks had actually done any, I would say, serious work on climate and nature-related risk management, because that's what we are talking about, risk management. Now, more than 90%, and this is a number of already, I think, a year ago, so maybe it's even higher, of banks have very explicitly said that for them, climate and nature-related risks are material. I think there's no need for us to be some kind of a cheerleader, because they know for themselves that this is material. So that would be, I think, the answer to your second question. As to the first question, how well prepared are banks, and more specifically on transition plans, I would say also there, if you compare where banks were in 2019, when we came out in 20 with our expectations, all the things that we have done and that I have been talking about for quite some years, I think banks have progressed a lot. Actually, you might have seen that some months ago I came out and I specifically thanked the bank, which is not something that supervisors normally do publicly, for the progress that they have made. Now, so that also means that the way that we will look at specifically transition planning will not be, as of yet, a big, large, horizontal push like we did some years ago, because we really felt that banks needed to, to step up to the challenge, which they have done. So what we will do next year is engage with banks, have lots of conversations, see how they are going to be implementing the transition plans that you referred to. So we will take it from there, and I think that the work that has been done so far, all the banks now having done a materiality assessment, banks having moved forward on our expectations, I think that puts them in a good place.
Thank you very much. We have one more question from Reuters. Balázs.
Thank you so much. Very broad question, which is about excess liquidity provided by the ECB. It has dropped by 2 trillion over the years, but it's still quite high. How far are we from that point where excess liquidity can no longer decline and still provide the necessary funding for the banking system? When could we reach that point where excess liquidity should no longer drop further? Is this going to come in 2026? And what is the level that is? Do you think that's the minimum that's going to be required?
Well, that's a question. You've seen the liquidity indicators, and I will say something on this in a second. But this is, of course, a question which is also related to monetary policy. And yes, we have the separation principle. So I don't comment on the liquidity provision through the ECB. What I can say is, when you look at the indicators for the banks, the liquidity indicators, they have been very stable over the past years almost. So they were a bit higher a few years ago, but then recently they've really stabilized. And I think this is good news, because there was also the concern with the move from QE to QT, that this would have implications for the liquidity position of the banks. But this has not happened. So the European banks liquid. All the liquidity indicators are in a very good range. And I must say also, when you look at the tensions that we had on markets, I mentioned this earlier, around the tariff announcements and then the revaluation of assets, there was also maybe for a short term a concern that it might also affect the liquidity of the banks. But also there we've seen that the banks could deal with this short-lived stress on the markets quite well. We monitor this very carefully. So we have, as you know, since 2023, we have a weekly liquidity monitoring, which gives us much more timely information. And we've also told the banks, and we also public with that of course they need to prepare also for the changes in the monetary policy environment. They need to be prepared. They need to pre-position collateral. But all this is going very, very smoothly right now, and you see it basically also in the data.
Thank you very much. I don't see any more hands on online, and also I think in the room we've satisfied everyone, and obviously we've given you a lot of information, so that's good to work through. So we can conclude the press conference here. Thank you very much for coming, and thank you very much for logging in online.
Thank you very much.